The foreign exchange market is a vital system in the global economy, where currencies are traded, exchange rates are determined, and international transactions are made possible. In this video, we will explore how this market works, why it matters to businesses and governments, and how it affects everyday life, from the prices of goods to the overflowing or the flow of investment worldwide. The foreign exchange market, or often called as the Forex, is like a big marketplace where people buy and sell different countries' money. Or for the simpler definition, the foreign exchange market is where currencies are being traded and where exchange rates are decided. Okay? So, for example, if someone in the Philippines wants to buy something from the US or United States, they need dollars, not pesos. Okay? So, they go through the foreign exchange market to swap pesos for dollars. The same happens worldwide, like tourists, businesses, banks, and even governments use this market. Okay, for example, is that when you go to airport or international airport, there is a place or marketplace where you can exchange currencies kung saan ka man pupunta. For example, I am going to Japan and I am not yet or hindi pa ako nakapag-exchange ng yen. Yen ba ang Japan? I think so. Yen ang Japan. So, I need to go to the exchange rate market or foreign exchange rate market sa airport para mag-exchange ng currency into yen or to Japanese yen. Okay? Now, what is foreign exchange rate? Foreign exchange rate is the value of one country's money compared to another country's money. Okay? For example, if you travel to United States with Philippine peso, you can't buy things there with pesos. Of course, because the currency in US is not a peso, but a dollar. So, you have to exchange them for dollars. If the exchange rate of Philippine peso is 56, or the value of $1 is 56 pesos, then your 560 pesos will become $10. So, the foreign exchange rate tells us how much money you get when you swap one currency to another or when you exchange one currency to another. Okay? Currency speculation is when people buy and sell foreign exchange. Bakit mabilis? Currency speculation is when people buy and sell foreign money or currencies to try to make a profit from changes in exchange rates. Okay? So, for example, or try to imagine that you buy $1 when it costs 55 pesos in Philippine peso. Okay? $1 is equals to 55 pesos in Philippine peso. So, later, the exchange rate changes and the 1 peso dollar is 57 pesos na. So, from 55 to 57 pesos na. Okay? If you sell your dollar now, you get 57 pesos. Meaning, you earned 2 profit. Okay? That's currency speculation. Guessing or predicting that the value of a currency will go up or down, then trading it to make money. Okay? So, merong mga people na ginagawa ito as a business or as a side hustle, ganon, which is nagko-collect sila ng mga dollars or Philippine peso, and then kapag magtaas na yung exchange rate, pinapalitan nila ito. Okay? Let's move forward to carry trade. Carry trade is when investors borrow money in a country with low interest rates and then invest it in another country with higher interest rates to earn profit from the difference. Okay? For example, for the carry trade is that just imagine that you borrow money in Japan where there is 0 interest rate. Okay? Then you use that money to invest in Australia where the interest rate is 5%. You pay little to borrow, but earn more from the investment. That's your profit. Okay? So, it is some people ways how to make a profit or how to invest and make the borrowed money into a bigger amount. Okay? Next, we have here the foreign exchange risk, which is the chance of losing money because of the value of currencies changes. Of course, the currency changes every year, every quarter, every year, every decades, or every century whatsoever. Okay? So, this risk happens. Okay? For example, a Filipino company sells products to the US or United States and is supposed to receive $1,000. Okay? So, today, the Philippine peso is 56 pesos, right? So, they expect 56,000. Okay? But, by the time they get paid, the rate changes to $1. I mean, 54 pesos is equals to $1. So, nagbaba yung value ng dollar sa Philippine peso. So now, yung $1,000 is only 54 pesos. They lost 2,000 because of the exchange rate changes or the risk in exchange rate. That is the loss of foreign exchange risk, which is, since timely naman, or there are times na nagbababa talaga or tumataas yung exchange rate, doon nagkakaroon ng risk sa exchanging or exchanging currencies. So, there are three types of exchange rate risk, okay? Number one is the spot exchange rate, which means a spot exchange rate is the price of one currency in terms of another for immediate exchange, or usually it takes 2 business days. So, for example, today, or in 2025, the spot rate is 56 pesos for a $1. If I need dollars now, I can exchange instantly the 5,600 into $100. Okay? Which means, or for a very simple meaning, ang spot exchange rate is an immediate exchange. If you need it now, I will give it to you, or I will exchange it to you now. Okay? So, number 2 is the forward exchange rate. Forward exchange rate is the agreed price of one currency in terms of another for a future date. It is used to protect against currency changes. Okay, so in this case, there are 2 countries, or there are 2 individuals agreed that whatever the changes are, is ganun rate pa rin ang babayaran in the future. Hindi tataas, hindi bababa. Okay, so for example, a Filipino importer knows that he must pay a $10,000 to a US supplier in 3 months. He makes a forward contract with the bank today at a $1 for 56.50 pesos. Even if the rate changes in 3 months, he is guaranteed that the rate avoiding unexpected losses. So that is the example of the forward exchange rate. Next, and the last one, is the currency swaps. It is an agreement where 2 parties exchange currencies now and agree to swap them back later. It is often to manage long-term risk or loans. Okay? So, what is the example for this? Okay? Example that there is a 2 businesses that, or wait lang. For example is that, imagine a Philippine company needs US dollars, while US company needs pesos. Try to imagine. They swap about 56 million and 1 million today. After 1 year, they agree to swap back at the original rate. Okay? So this way, both companies, or the 2 companies, get the currencies they need without worrying about rate changes during that time. Okay? It is an agreement of both 2 to avoid the foreign exchange risk.
The nature of foreign exchange market. Foreign exchange market, it is a global network of banks, brokers, and foreign exchange dealers that is connected by electronic communication system. Okay, so when we say foreign exchange market, hindi ito yung actual physical market na binibilhan natin. So ito yung ginagamit ng mga company na nakikipag-transact sa company sa ibang bansa. Ginagamit nila ito para mag-exchange ng currency. So everyday, trillions of dollars ang dumadaan na pera sa foreign exchange market. Kaya ito tinawag din na the largest financial market globally. So these are the most important trading centers. First is the London. 17% of the activity in Forex is London ang nagpa-facilitate. Then next is New York. So 18% ng activities sa Forex ay New York ang nagpa-facilitate. Next is the Zurich, Tokyo, Singapore. Sila naman yung nagpa-facilitate sa 5 to 6% ng activities sa Forex. And the next, the second major trading centers naman are the Frankfurt, Hong Kong, Paris, and Sydney. So merong 2 features ang Forex. First is, this market never sleeps. So, ibig sabihin, nag-ooperate ang Forex sa loob ng 24 hours. Yung mga centers like yung nabanggit ko kanina, Tokyo, London, and New York, nag-off lang sila for 3 hours, and during those 3 hours, ang nagpa-facilitate ng activities ay ang San Francisco and Sydney, Australia. So, the second feature of this market is the integration of various trading centers. So, nagiging connected ang mga trading centers through electronic networks, which allows seamless flow of information and transactions. So dahil dependent sila sa isa't isa, each trading center is nakakaapekto and naapektuhan siya ng ibang trading centers. So we have what we call arbitrage. This means buying currency at a low price and selling it in high price. Economic theories of exchange rate determination. Exchange rates are determined by the demand and supply of one currency relative to the demand and supply of another. If mas mataas ang demand for dollar kaysa sa supply nito, and then ang supply naman ng yen is mas mataas kaysa sa demand nito, ibig sabihin, mas tataas ang value ng dollar and bababa ang value ng yen. So, ma-apply dito yung law of demand and supply. Kapag tataas ang demand, bababa ang supply. Kapag tataas ang supply, bababa ang demand. So, parang sa product lang din yan. Kapag mas mataas ang demand ng isang product, let's say for example, bag, mas bababa ang supply nito kasi marami na ang bibili. Kapag naman mas mataas ang supply, bababa ang demand kasi ibig sabihin marami na silang source and lahat sila nakakakuha na kaya nagde-depreciate na ang value nito. The law of price. This states that in competitive markets free of transportation costs and barriers to trade such as tariffs, identical products sold in different countries must sell for same price when their price is expressed in terms of same currency. So for example, using the exchange rate between British pound and dollars. Let's say 1 pound is equal to $2. So let's say you bought jacket from US for $80 and you plan to sell it sa UK. So dapat ang benta mo is same price lang sa kung magkano mo siya nabili. Pero dapat i-convert mo ito into pound. Kaya ang magiging price nito is kapag binenta mo sa UK is 40 pound. So basically, bibili ka in dollar pero pagdating mo dun sa country na pagbebentahan mo is naka-convert na siya into pound. So another example is kung ano yung price ng iPhone sa Hong Kong, dapat same lang yun sa ibang country. Purchasing power parity is an economic theory that compares different countries' currencies through a basket of goods approach. Purchasing power suggests that exchange rate should adjust so that the basket of goods cost the same in different countries. So for example, ang isang basket ng grocery sa US is $100 and 2,000 peso naman sa Mexico. So para mag-balance, dapat ang purchasing power exchange rate ng Mexico is 20 peso per dollar para mag-equal ang cost. So ang goal is to find an exchange rate that would allow the same amount of money to buy the same amount of goods and services in any countries. Money supply and price inflation. The growth rate of country's money supply determine its likely future inflation. Kapag tumaas ang money supply ng isang country, magkakaroon ng price inflation. Kasi yung mga tao, mabilis na lang silang makakakuha ng pera or makakahiram ng pera sa bank and lahat ng gusto nilang bilhin is mabibili na nila. So ang mangyayari is mag-i-increase ang demand sa product and magdi-decrease naman ang supply dahil sobrang dami nilang gustong bilhin. So we all know na limited ang resources. Kaya kapag tuloy-tuloy ang pagtaas ng demand, ng mga tao is liliit lang yung resources. So doon na magkakaroon ng inflation. So inflation occurs when a quantity of money rises faster than the stock of goods and services. That's when the supply increases faster than output increases. Kaya hindi pwedeng magprint ang government ng pera dahil mababawasan lang ang value ng currency nito and magkukos ito ng price inflation. Just like what happened sa Zimbabwe noong late 2000. Naka-experience sila ng hyperinflation dahil sa excessive money printing na ginawa ng government. Kaya nawalan ng value yung currency nila. Empirical test of purchasing power parity. The test conclude that purchasing power parity was relatively accurate in predictions of exchange rate in long run, and it is less useful for predicting short-run exchange rates movement. So, bakit nga ba less useful ang purchasing power parity sa pag-predict ng short-run exchange rates? This is because in short-run exchange rates are highly volatile and it influenced by several factors such as interest rates, capital flows, and market sentiment, and etc. And also, ang mga price ng goods and services ay hindi immediately maka-adjust kasi syempre may mga contracts na hindi agad-agad pwedeng mapalitan.
Now, let's talk about how a country's money or currency is valued and how people try to predict what it will be worth in the future. We will cover the main factors and the different ways experts think about this. interest rates and exchange rates, let's talk about the simple relationship between interest rates and exchange rates. So when a country's central bank raises its interest rate, it's like a bank offering a higher interest rate on your savings. This makes people from other countries want to put their money in that country to get a better return. To do this, they have to buy that country's currency. This high demand makes the currency's value or its exchange rate go up. So generally, high interest rates lead to a stronger currency. The Fisher effect. This concept explains that a country's nominal interest rate, the one you see advertised, is made up of two things: the real interest rate and expected inflation. Inflation is how fast prices are rising. The Fisher effect shows that if inflation is expected to be high, interest rates will also be high to compensate investors for the loss of their money's value. It's a key part of how interest rates are set. Next is the International Fisher Effect, or IFE. IFE suggests that the difference in the interest rates of two countries is equal to the expected change in their future exchange rate. The basic idea is that a country with a much higher interest rate will see its currency depreciate or lose value in the future. The market expects this to happen to balance out the higher return from the interest rate. Next is the investor psychology and bandwagon effects. Have you ever wanted to buy something just because everyone else was? That's the bandwagon effect. This also happens in currency markets. Sometimes people are not perfectly rational. Their decisions are influenced by investor psychology, emotions like fear and greed. This can lead to a bandwagon effect where traders start buying or selling a currency just because others are, which can push a currency's value up or down based on hype, not just on a country's economic health. Now, let's move on to approaches to forecasting. So, with all these factors, how do people try to predict what a currency's value will be? There are two main approaches to forecasting, which is fundamental analysis and technical analysis. Example, these two approaches lead to two different schools of thought. The efficient market school believes that forecasting is a waste of time. They argue that all information is already reflected in the current exchange rate. So trying to predict the future is impossible. On the other hand, the inefficient market school believes that markets are not always efficient and that some forecasting methods can work. So, fundamental analysis. This approach is the complete opposite. Fundamental analysis looks at a country's economic fundamentals to predict its currency's value. This includes looking at things like the country's balance of payments, inflation, and interest rates. The core belief is that if a country's economy is strong, its currency should be strong. Technical analysis. This method is used by those who believe the market is inefficient. It uses all data, specifically price and volume data, to find patterns. The basic idea is that the past trends are expected to continue into the future. It's like a person trying to predict the future by looking at history books. This approach does not rely on a consideration of economic fundamentals.
Currency convertibility. First, I will explain currency convertibility. A currency is freely convertible when residents and non-residents can exchange it for foreign currencies without limits. If only non-residents can exchange, it is called externally convertible. When no one can exchange, it is non-convertible. Many governments restrict convertibility to protect foreign exchange reserves and avoid capital flight, which happens when people quickly exchange local currency for foreign ones due to inflation or economic instability. Next is countertrade. Countertrade is when goods and services are traded directly for other goods and services instead of money, especially in countries with non-convertible currencies. For example, General Electric once accepted Romanian's goods instead of cash for a 150 million project. Similarly, Caterpillar exchanged equipment for Venezuelan iron, which is then traded for other products. Today, countertrade is less common, involving less than 10% of world trade, because of most currencies are now freely convertible. Next is transaction exposure. Transaction exposure, this refers to the short-term risk of exchange rate changes on specific transactions. For example, an American airline bought 10 Airbus planes for $1.2 billion. At the contract time, the dollar was stronger, so they expected to pay about $1.9 billion. But when the dollar weakened, the final cost rose to $1.5 billion. The extra $0.41 billion is transaction exposure loss. Translation exposure. So translation exposure is different. It is the impact of exchange rate changes on companies' financial statements. For example, if a U.S. company has a subsidiary in Mexico and the peso weakens, the dollar value of the subsidiary's profits and assets falls, this can make the company look weaker financially, raising its debt ratio and borrowing costs. In early 20s, many U.S. firms suffered losses when the euro depreciated against the dollar. Later, when the euro rose, they gained from the positive translation exposure. So, to summarize, currency convertibility and the countertrade show how countries and companies handle exchange restrictions, while transaction, translation, and economic exposures explain how exchange rate movements affect businesses in the short term, in accounting, and in the long term.